Hi, I'm David Stein of Money for the Rest of Us. This is the channel on money, investing in the economy. In today's video, we're looking at the 3 best ETFs to combat rising inflation, higher interest rates, and we're going to look at other options that aren't ETF-based to protect against inflation. Let's get started by first looking at how bad inflation has gotten in the U.S. The U.S. Bureau of Labor Statistics recently released inflation data. It showed that the headline consumer price index was over 5%. Core, excluding food and energy, was over 4%. We can look at inflation over time. You can see in the purple the impact of energy prices, but look at core inflation. 30% of core inflation is shelter. And those recent inflation numbers only have shelter costs at about 2.5%. And with the big jump in housing prices, the upcoming increase in rent as housing prices have gone up, it's quite possible we could see much higher inflation and potentially higher interest rates. The typical or the standard investment for protecting against inflation are Treasury inflation protection securities, or indexed bonds. But there's a challenge with indexed bonds right now. The interest rates on them are negative. If you look at this particular chart, it shows on the right-hand scale the yield on TIPS. And right now, TIPS are showing a negative yield, which means that your overall return, even though the price of TIPS is adjusted as inflation comes in, anyone holding TIPS right now will not keep up with inflation over the long term because of that negative yield. Now, some people like to own gold to protect against inflation. I have about 5% of my net worth in gold, but gold doesn't necessarily keep up with inflation every single year. It has over the long term, but it's not a perfect inflation hedge. Right now, Treasury inflation protection securities, while they are adjusted based on the rate of inflation because of that negative yield, they aren't likely to actually keep up with inflation either. The other challenge we have right now is that overall interest rates are low. This is just the yield on U.S. Treasury, so not the real yield. And look at the big gap between that 10-year Treasury yield and current inflation rates. Now, the best investment I know for at least U.S. investors to protect against inflation are I-bonds. And I-bonds are a type of savings bond issued by the U.S. government. The beauty of I-bonds is their interest rates are adjusted based on the rate of inflation, but the yield, the base yield, is zero. It cannot go negative like TIPS. So if you actually buy an I-bond, you'll get that base rate, which in the current environment is zero, plus the rate of inflation. The challenge with I-bonds is you can only invest about $10,000 per year. But if you're looking to protect against inflation, I-bonds is the first place to start, recognizing that there's an interest rate penalty if you hold them for less than 5 years. On the Money for the Rest of Us website, there's a guide, a complete guide to investing in Treasury inflation protection securities and I-bonds. You can learn about both of those particular investments. In today's video, though, we're looking at ETFs to protect against higher inflation and rising interest rates. And I want to give some warning here on this particular topic. First, this is not investment advice. So I'm teaching and providing general education. All three of these ETFs I don't own personally currently, although one is a Simplify ETF, and the Simplify family of ETFs is a sponsor of my podcast, but they're not sponsoring this video. So each of these ETFs is very different. A couple of them are more risky than others, and we're going to take a deep dive, and then we'll circle back at the end and kind of compare and contrast. But let's first look at the Quadratic Interest Rate Volatility and Inflation Hedge ETF. The ticker is IVOL. This particular ETF was launched in May 2019 by Crane Shares, and Quadratic Capital Management. The founder of Quadratic Capital Management is Nancy Davis. She's an expert on options. This ETF has been extremely successful. $3.3 billion in assets under management. The expense ratio is 1.05%. Now, this is the one ETF we're going to share that actually is invested in TIPS. About 89% of this ETF is currently invested in the Schwab US TIPS ETF, SCHP. But the remaining assets and cash are invested in interest rate swap options, or what are known as swaptions. Now, what this is the way that this particular ETF is seeking to protect against rising interest rate and inflation. As it protects against inflation with that TIPS piece, and we've talked about some of the challenges with the current environment with TIPS with the negative yield. The option piece, it's a option based on the difference between the 10-year Treasury yield and the 2-year Treasury yield. And so this particular option or swaption will do fine as long as that gap, that spread between what two-year Treasury yields are yielding and 10-year, if that gap widens, then that particular option will pay off and it will help protect the ETF holders against rising interest rates and hopefully inflation. Now, there is a potential loss if 2-year interest rates rise and the 10-year doesn't rise as much. And so that gap narrows. And so this is a very specific bet within this ETF on the difference between 10-year Treasury yields and 2-year Treasury yields. Now, if interest rate volatility increases, then this particular option will also do well. But most of these assets are invested in TIPS, and then there's this option overlay. Nancy Davis and her team are experts on options. So that's the first ETF example, the Quadratic Interest Rate Volatility ETF. Our next ETF is the Simplify Interest Rate Hedge ETF. Ticker is PFIX. This is also a newer ETF. In fact, all three of these are fairly new ETFs. This one launched in May 2021, so very, very new. Only $100 million in assets, about 0.5% expense ratio. It's invested 64% in 5-year U.S. Treasury bonds. So it's not in a TIP, it's in a traditional 5-year bond, so it's not getting impacted by negative interest rates. But its remaining assets, about half, based when this particular ETF started, its inception, is in an interest rate swap option, another swaption, along with the cash that goes with that. This particular swap is a little more risky than the one that IVOL is using. This is a 7-year forward 20-year payer swaption with a strike price of 4.25%. Now that sounds really complicated. What does that actually mean? That means if 7 years from now, the interest rate on the 20-year Treasury bond, that yield, if it's above 4.25%, then this option is in the money, it pays off, and this ETF will make substantial money. If the yield on the 20-year Treasury bond is lower than 4.25% at the time that in 2028, so about 7 years from now, then there will be some potential major losses with this ETF. Now, in the interim, that swap value will change in price. Right now, it's down about 20% since May, and that you'll see that in the ETF return numbers. But if it's above current interest rates, so right now the yield on the Treasury, 20-year Treasury, about 1.8. If this particular option goes in the money, so the 20-year Treasury bond yield is above 4.25% in 2028, this ETF potentially could earn 300% or more, about 3 times its current price. Now, that's a big win, but in how you use this ETF, you have to recognize it will be volatile because of the swaption, and it is a very, very specific bet on rising interest rates and a fairly big jump in interest rates over the next 7 years. The next ETF is the Horizons Kinetics Inflation Beneficiaries ETF. INFL is the ticker. It's also fairly new, launched January 2021. $700 million in assets, 0.85% expense ratio. Now, this is primarily stocks. 98% invested in stocks, equity real estate investment trust, and royalty trust. Their approach to protect against inflation is to invest in profitable, well-managed companies that will benefit from inflation, but don't need high inflation in order to be successful. So this is a pure equity investment, REITs, royalty trust. What royalty trusts are companies that own land and mineral rights. And those companies don't own oil wells, but they will receive oil and gas income from leasing out the land that they own. Now, that's a big portion of this particular ETF currently. It can change its holdings, but it is concentrated. About 37 holdings. So a concentrated ETF, 45% of the assets are in the top 10 holdings, but it's trying to benefit from rising inflation that could help certain companies, the companies that they choose. And the returns will be tied to the overall stock market, but if we also get a period of high inflation, this ETF should do well. So we have 3 ETFs. 2 of them are fixed income based, using option strategies to protect against rising interest rates and higher inflation. The third is pure equity, so very different structure. Be very careful when you invest in these. They may or may not do well. Now, I don't own them personally currently. I certainly continue to research them. I've done episodes on them for my premium podcast on Money for the Rest of Us Plus. But understand the particular risk, particularly with the Simplify ETF. That's the most risky in terms of what interest rates do. The Horizon ETF is most risky in terms of the stock market. And the IVOL, the Quadratic interest rate volatility ETF, is sort of in between. Hopefully you have found this particular video helpful if you're trying to protect against inflation. Check out that guide on my website on investing in I-bonds and tips. And I would start with investing in I-bonds, the simplest way to protect against inflation. I own a good portion of I-bonds. As many as I can buy, I buy them. But if you're also looking for some additional ways to hedge and protect against rising interest rates and inflation, these 3 ETFs can be helpful. Thanks for watching the video. If you have any questions, leave them in the comments below. Please subscribe to my channel. I'd love to have you subscribe. Click the bell so you get notified every time we put up a new video. Thanks.